Look at this chart. Down 99% from its highs, trading at multi-year lows. Valuation looks cheap by almost every metric. The story sounds compelling. Management change, balance sheet cleanup, recovery plan announced, a takeover bid. The question is simple. This this is a turnaround or a value trap? Because here's the uncomfortable truth about these two things. They look identical at this stage. Same drawdown, same cheap valuation, same narrative of recovery, same retail investors piling in on the story. The difference between them is not visible in the price. It is not visible in the valuation multiple. It is not even visible in the most recent quarterly results. The difference lives in one question, and it is the first question I ask every single time I look at a beaten down stock before I go further. I've been investing in turnarounds long enough to have gotten some of them wrong. I've sat in positions I believed in, done the research, understood the business, felt the conviction, and I watched the thesis slowly unravel because I was holding a recovery story with no execution behind it. Those experiences are expensive, but they are also the most instructive things that has ever happened in my investment process. Because getting a value trap wrong and catching it before it destroys a significant capital or teaches you something that no textbook, no course, and no analyst report can ever. It teaches you exactly what to look for. In this video, I'm going to show you the complete framework that I use to distinguish a genuine turnaround from a value trap. Before I commit the research time, before I commit capital, and during the position when the thesis starts showing cracks. This is not theoretical. This every element of this framework came from real money positions that I've worked and built. Let's start with one question that filters out more value traps than anything else I've ever found. On Before I give you my framework, I want to make sure we are working from the same definitions because the word turnaround and value trap get used constantly in investing, and most of the time they're used loosely, casually, in a way that makes them sound like opposite ends of a clear spectrum. Well, they're not. There are two outcomes that are almost indistinguishable at the moment of decision, and in that indistinguishability is precisely what makes this the hardest category of investing to get constantly right, and the most profitable category to invest in. So let me define both precisely, and I mean precisely, not loosely. Turnaround is a fundamentally sound business that encountered a fixable problem. Okay, I want to break down the definition word by word because every word is doing something specific. Fundamentally sound meaning the core economics of the business are intact. The product or services that has demand. The competitive position, while potentially weakened, is not permanently destroyed. The business model stripped of the problems that cause is the business model is stripped of the problem that caused the decline and is capable of generating a reasonable return on capital. Fixable problems, meaning the cause of the decline is not structural to the business itself. It is something that happened to the business or something that was done badly within the business that can be corrected. Governance failure, operational management, temporary demand collapse in a technical industry, over leveraging the business with strong underlying cash generation. These are fixable. They are painful. They often are ugly for an extended period, but they are not permanent. Now let's fill out the table here. Cause of decline. Fixable, not structurally structural to the business model. Business model. Enter business model relevance. Demand for the product product or service still exists. Management, the people responsible responsible for the problem has been replaced, or the conditions that enabled the problem has been removed. Balance sheet, sufficient runaway to survive long enough for the recovery to materialize to materialize to materialize. Execution evidence, early signs, even small ones that the recovery is real rather than just announced. And then we'll just do this. Okay, we'll just crop these, not this, like that. Good. And make this a little bigger. Okay. Okay. Value trap is a business that looks cheap because the market has correctly identified that something is permanently broken. And I want to emphasize the word correctly. The market is not right all the time, but in value trap situations, the discount being applied to the stock is often a rational response to a genuine and permanent impairment of the business economics. The trap is not that the market is wrong. The trap is that the investor believes the market is wrong. Permanent impairment takes several forms, such as structural demand destruction, where the product or is being made obsolete, not in a cyclical way. It's like permanently displaced way. Think of a business that missed technology transitions, industry disrupted by structural change, products replaced by fundamentally superior alternatives. The demand is not coming back because the reason for the demand is no longer exist ex, th- because of the reason because the reason of the demand no longer exists in the same form. Permanent capital competitive displacement. A dominant competitor has taken market share in a way that cannot be reversed because of the economics to recapture are impossible. The cost structure required to compete has changed permanently. The customer relationships are gone, and rebuilding them requires more capital than the business can generate. Debt levels beyond recovery, where where even a full operational recovery cannot generate sufficient cash flow of to service obligations, maintain operations, and to invest the future simultaneously. The balance sheet has become the business, and it is a business of managing liabilities, not creating value. Regulatory or legal impairment, where the business model itself has been permanently altered or restricted by regulatory action or legal liability in a way that removes the economics that justified the original valuation. Now let's fill in this table for value traps too. Structural permanent impairment, structural permanent impairment of business economics. Demand is structurally declining. Demand is structurally declining, or competitive positions is permanently permanently mm, is permanently displaced. Sorry for my spelling errors. Management change at the top cannot fix what is broken at the foundation. Balance sheet insufficient sufficient runway or permanent debt to debt overhang that recovery recovery cannot overcome. Execution evidence narrative of recovery consistently, consistently running ahead of actual results quarter after quarter. Now look at both of the columns together. Here's what I want you to notice. Here's what at at the moment of maximum pessimism, with with the stock at its lows, when the news is bad, when sentiments is negative, the table looks identical from the outside. Both columns have a beaten down stock. Both have cheap valuations. Both have a story. Both have management saying the right things about recovery. The difference between the left column and the right column is not visible in the price or the value or the P ratio or PB ratio. It is not visible in the most recent quarterly results in isolation. The the difference lives in the diagnosis. Why did this business fall? Is this a is this is that cause fixable, or is it permanent? That single question, asked rigorously, answered honestly, without the bias of wanting the stock to be a turnaround, is my first filter, and it eliminates more value traps before they cost me capital than any other single thing does. But asking the right question is only half the work. The harder part is answering it correctly, especially when the story sounds compelling, the valuation looks attractive, and the optimism is building. Let me show you exactly how to answer it. This is the question that does more work in my process than anything else I do. Not the valuation, not the quarterly results, not the management commentary. The first question I asked before any of those is this: why did the business fall? And is the cause fixable or is it permanent? I ask it first because everything is the downstream of this question depends on the answer. Valuation only matters if the business can recover. Management quality only matters if the problem is one that management can solve. Balance sheet analysis only matters if the business model itself is worth saving. If the cause is permanent, nothing else matters. The stock is cheap and for a reason that will not go away. No amount of analytical work or any other variable change will reach that conclusion. So I spent a disproportionate time here before I open a spreadsheet, before I read a quarterly result, before I look at the valuation. I try to answer this one question honestly as I can. Let me show you what a fixable cause looks like in practice. This business fell because of governance and risk management breakdown at the leadership level. The founder built an aggressive growth culture that prioritized expansion over discipline. Standards slipped, problems were hidden, and when they surfaced all at once. creating a crisis that looked existential. But underneath was a governance failure. The franchisee was intact, the customers were still there, the product was still relevant, the competitive position, while damaged, was not destroyed. The infrastructure, the branches, technology, relationships survived the crisis even when the management didn't. When I ask, is this a fixable cost? Is this a fixable cause? The answer I hear is yes, because the cause was the people running the business, not the business itself. Replace the people, overhaul governance, clean up the balance sheet, and the underlying franchisee has a potential to recover. Now this is a turnaround. Now look at this one. The business fell because of a massive debt trap caused by over-leveraging, aggressive diversification across capital-heavy sectors like real estate, power, and cement, and the fallout of the 2008 crisis. The management was competent, the balance sheet was catastrophic, the valuation looked cheap by conventional metrics. Every surface indicator said it could recover. But what I asked is this cost fixable? And the honest answer was no, because the cause was not how the business was run. It was what the business did and how the business did it. And and the business was becoming permanently less relevant because it couldn't keep up with its competitors and it couldn't repay the debt. No management change fixes structural demand destruction. No balance sheet cleanup restores competitive position that has been permanently displaced. No valuation discount compensates for a business whose economics are permanently impaired. This is a value trap. Now I want to make this framework more precise because fixable versus permanent sounds simple in theory and is genuinely difficult in practice. The ambiguity lives in the middle. Situations where the cause is partially fixable or where fixable and permanent elements intertwine. So let me give you the taxonomy I use, the specific categories of causes, and how I classify each one. Fixable causes, and what are they like? So first, it's governance failure. With a genuine management replacement, the key word is genuine, not the cosmetic reshuffle where the same culture persists under a new title, but the structural overhaul where the people, the processes, and the incentive structures that enabled the failure has been replaced. Yes Bank is a live example of this. Rana Kapoor gone, board suspended, RBI oversight installed. Institutional shareholders with board representation introduced. This is genuine replacement. Cyc- Cyclical demand collapse. In in a structurally sound industry, when an entire sector goes through a down cycle, real estate, commodities, infrastructure, and even power, individual companies within the sector can look permanently impaired when they are actually cyclically depressed. The diagnostic question is whether the industry itself has a structural future. If yes, cyclical weakness is a fixable cause. This, or a real life example of this, would be the media industry or the FMCG industry. Like here, FMCG. Like as you can see, FMCG has fallen a lot, and no one is gonna no one is gonna stop using Colgate, or no one's gonna stop buying Gillette in a war. Like even in 2008 crisis, tell me if you stopped brushing your teeth or stopped shaving. FMCG is a defensive sector, and it shouldn't be treated like it's power or infrastructure. Where if the economy does bad, the entire sector will collapse. Let's move on to the third cause, and it's temporary over leveraging in the in a business with strong cash generation. Companies that took too much debt during an expansion phase, but whose underlying operations generate strong and stable cash flows, can service and reduce the debt over time. The leverage is the problem, not the business. If the business can generate its way out of the debt without external capital, the cause is fixable. Man- Operational mismanagement corrected by new leadership. Poor cost discipline, insufficient capital allocation, bad acquisition decisions. These are management these are management problems, not business problems. If the underlying unit economics of the business are sound and new management has the mandate and the capability to correct the operational issues, the cause is fixable. Now let's move on to permanent causes. The first permanent cause is structural demand destruction. I want to be very specific about how to identify this, because cyclical weakness and structural displacement feel identical in the short term. The diagnostic is the demand driver. Ask what is causing customers to use this product or service less. If the answer is economic condition, credit availability, or consumer confidence, this is cyclical. If the answer is a permanent shift in how customers meet the same underlying need, a technology transition, a behavior change, a regulatory elimination of the use case, that is a structural that is structural. Cyclical demand returns when conditions improve. Structural does not. Structural demand destruction is like in the case of Dream 11 with online gambling. One rule, the government passed one rule and the entire industry collapsed. Dream 11's Dream 11 lost 99% of its value overnight. The second cause is permanent competitive displacement. When a competitor has built a cost, technology distribution, or brand advantage that cannot be overcome with new available capital, the displacement is permanent. The diagnostic is the economic of recapture. What it could cost to rebuild the competitive position. Is is that cost achievable given the capital the business can generate or raise? And is and if the honest answer is no, the displacement is permanent. Okay, debt beyond recovery capacity. Debt beyond recovery capacity. Calculate the free cash flow of the business at normalized operations. Calculate the debt service obligations. Calculate the investment required to maintain competitive position. If those three numbers don't leave enough room to reduce debt meaning debt meaningfully over a reasonable time frame, the balance sheet is in a permanent impairment, not a temporary one. A regulatory or legal elimination of the business model. Some businesses are structurally impaired by changes in regulatory environment that permanently alter the economics. This is particularly relevant in financial services, pharmaceutical, or heavily regulated industries. Mm, the diagnostic is the regulatory change permanent or reversible? Is it specific to this company or industry wide? Industry wide permanent regulatory changes are typically a permanent cause. Now, this is a more accurate example of what happened to Dream 11, not the previous one. Okay, and now I want to address the hardest case directly because the framework I've just described handles the clear situations well. It struggles with what every framework struggles with, the ambiguous middle. The business where governance failed but competitive positions also weakened. The company where uh, the demand is cyclically depressed, but there are structural headwinds emerging simultaneously. The institution where management has changed, but the culture that it created that created the problem is still embedded in the organization below the leadership level. There are the situations most where the most expensive mistakes are made, and they are expensive precisely because the fixable element of the cause make the position feel justified, while the permanent element quietly compounds the damage. My approach to the ambiguous middle, uh, and I want to be honest, this is this is judgment, not a formula. Is ask one additional question: if the business executes its recovery plan perfectly over the next 3 years, does it emerge as a competitively viable, economically sound franchisee, or does perfect execution simply slows the decline? If perfect execution leads to a genuine recovery, the cause is predominantly fixable and the position is worth holding. If the perfect execution merely shows a structural deterioration, the cause is predominantly permanent, and this position is a value trap regardless of how compelling the short term recovery metrics sound. The question, what does perfect execution actually um, produce, has saved me from more value traps than any other single diagnostic I've ever developed. Because value traps are not usually situations where the recovery plan is obviously wrong. There are situations where the recovery plan is entirely plausible and doesn't solve the fundament and still doesn't solve the fundamental problems. Now, even when the cause is fixable, there is a second trap waiting. And in my experience, it is one that catches the most serious investors, not the ones who skip the diagnosis, but the ones who got the diagnosis right and still lost money. It is the trap of optimism without execution, and that is what we're gonna look into next. But before that, I just want to say, if you think that this company is somewhere in the middle and it's the best policy is to just avoid the company if you're a conservative investor, because turnarounds, you have to have high conviction in them, and if you are not sure about this company, then you shouldn't invest in it. I want to talk about the most dangerous version of value traps, not the obvious one, the broken business, um, squandering as a cheap stock. Most serious investors catch that one eventually. The diagnosis of a permanent impairment becomes clear enough that even a compelling narrative can't sustain the position indefinitely. The dangerous version is different. It is a business where the cause is genuinely fixable, where the diagnosis was correct, the management changed, the recovery was credible, and yet the investment still destroys capital, not because the thesis was wrong, but because the market priced the recovery before the recovery happened. And the recovery never fully materialized at the pace or the magnitude the market had already paid for. This is market optimism without execution. And in my experience, it is the single most common reason serious turnaround investors lose money. Let me describe exactly what this looks like. Because if you've been investing for any length of time, you've probably seen this pattern and felt its pull. A company announces a turnaround plan, new management, new restructuring, strategic refocus, the language of a confident and specific margin targets, growth timelines, return on equity goals. It sounds credible because it is credible and the logic is sound. The plan makes sense. The stock bounces, early metrics show some improvement, revenue stabilizes, costs come down slightly, the quarterly loss narrows. Analysts analysts upgrade, retail investors pile in, the narrative builds momentum, and then quarter after quarter, something subtle happens. Revenue recovers, but margins don't follow. Costs come down, but the cost structure never reaches the efficiency the plan promised. Management keeps on guiding to targets and keeps on missing them by just enough that each miss can be explained away individually. Bad quarter blamed on external conditions, another blamed on one of items, another described as timing. But the pattern, individually explainable, collectively damning, tells a different story. The recovery is real, but it is shallower than the market priced. The execution is happening, but it is slower than the narrative suggested. And the stock, which had already moved on the promise of recovery, is now waiting for reality that keeps on arriving late and arriving smaller. The market optimism without execution, and by the by the time it becomes obvious, by the time the market conscious consensus shifts from this is taking longer than expected to this recovery is structurally limited, Significant capital has already been lost by investors who were right about the diagnosis and wrong about the timeline and the magnitude. So how do you detect it before it costs you? This is the score card I use, and I want to walk through each metric carefully because the individual metric matter less than understanding what each is actually measuring. Metric 1: return on equity trajectory. Not the absolute return on equity level, the direction and the pace of improvement. A genuine turnaround produces ROE that moves consistently in one direction, upwards. Even if slowly, quarter after quarter, year after year, the return on equity base improves as the recovery compounds. It doesn't need to improve dramatically, but it needs to improve consistently. Market optimism without execution produces ROE that stabilizes at a level below what the recovery narrative promised, and then stops improving. The bad loans are resolved, the costs are cut, and then ROE sorry, and then ROE plateaus at 8 or 9%. When the plan called for 14 to 15%, management explains the gap with external factors, but the gap persists. Metric 2: operating cash flow conversion. This is the metric that catches more narrative driven recoveries than any other single number. Reported earnings in a turnaround situation can be influenced by provisioning decisions, accounting treatment of legacy assets, and one-off items that can make profit line look better than and and then the underlying cash generation. Operating cash flow is harder to manage. It reflects what business is actually generating, cash in, cash out, what's left. In a genuine turnaround, reported earnings and operating cash flow move together. The profit improvement is real because it is backed by actual cash generation. In market optimism without execution, reported earnings improve while cash operating cash flow lags or diverges. The profit line looks good. The cash generation tells a different story. That divergence is one of the earliest and most reliable signals that the recovery is shallower than it appears. Metric 3: management guidance hit ratio. This is the simplest metric on the scorecard and one most investors underway. Track what management says, specifically the margin targets for the next 4 quarters, the cost to income ratio by year end, and the ROE goals for the next 2 years. Write it down, then check it against what actually happened. One miss is noise, two misses are in the same direction is a pattern. Three misses is a signal that management either does not understand its own business well enough or to forecast it accurately or understands it and is communicated optimistically to manage market expectations. Either interpretation is concerning in a turnaround situation because the entire investment thesis in a turnaround is built on a credibility of the recovery plan. And if the people executing it cannot accurately predict their own execution, the plan is less credible than it appears. Metric 4: the breadth of recovery. A genuine turnaround produces improvement that is broad based across the business, multiple segments improving, multiple metrics moving in the right direction simultaneously. The recovery is not concentrated in one flattering number, while everything else stays flat. Market optimism without execution often produces narrow recovery, one segment doing well, one segment improving dramatically, while the rest of the business shows no meaningful change. The headline number looks good. The underlying business is not broadly recovering. The diagnostic look look beneath the headline. If the net profit is improving, is it because of revenue growth or is it because of provisioning decline? If revenue is growing, is it broad based across all segments or concentrated in one area while others are flat or declining? If margins are improving, is it because the business is more efficient or because of one-off cost reductions created a temporary improvement that won't sustain? Metric 5: Cost structure improvement. In almost every turnaround, re- cost reduction is a part of the recovery plan. Management announces restructuring, headcount reduction, branch rationalization, operational efficiency programs. These announcements are always credible in the short term because cutting costs is easier than growing revenue. The question is whether the cost reduction is structural or temporary. Structural cost reduction changes the underlying cost base permanently. New technology replacing manual processes, genuine operational efficiency embedded in how the business runs. Fixed cost reduction does not reverse when growth resumes. This feeds directly into sustainable margin improvement. Temporary cost reduction cuts things that will need to come back. Underinvestment in technology, deferred maintenance, reduced marketing spend, headcount reduction in areas that growth will eventually require rebuilding. This creates a short-term margin improvement that reverses as business tries to grow. The diagnostic is the cost to income ratio improving because revenue is growing faster than the cost, or because costs are being cut in ways that may limit future growth. Both can look identical in the short term, only one is sustainable. That is when I start asking whether I'm holding a turnaround or a value trap. If there's no improvement and and the metrics are decreasing, then I become cautious and I review my thesis. And it and I may and I may make the decision to exit my position mid thesis sometimes. Sometimes wrong, sometimes I'm right, but mostly mostly when I'm when I exit mid thesis, I'm right. I want to tell you about a position I held and I believed in it completely. I had the diagnosis, the cause, the fixable operational mismanagement, um, under previous leadership, not a structural problem with the business itself. Management had changed. Balance sheet had enough runaway. Valuation looked compelling. Valuation looked compelling across multiple methodologies. I built the position. I had conviction. Then slowly, almost imperceptibly, in at first, the scorecard started running amber. Revenue was recovering, but margins weren't following at the pace of the recovery plan promised by management. Management kept guiding to cost targets they kept missing. Each miss event individually expl- explained, each explanation plausible in isolation. Operating cash flow was growing slower than reported earnings. Not dramatically, but consistently for 3 consecutive quarters. Each quarter, I told myself the same thing: this is temporary, the thesis is intact, give it more time. That instinct gave it more time. The most expensive instinct in turnaround investing. Because the time in a value trap is not neutral. Every quarter you hold on to the position where the thesis is quietly breaking you two paying two costs simultaneously: the direct cost of capital and the un, sitting in an underperforming position. An opportunity, a cost of capital not being deployed in a genuine turnaround where the execution is intact. The market eventually did what markets do. It priced shallow recovery. It priced shallow recovery. The stock that bounced on optimism gave back most of its gain in as reality of limited execution became undeniable. I exited at a loss. It was the investment process working exactly as it was designed to work. Because the alternative, holding a broken thesis because you don't want to take the loss, because you want to be right, because the original story sounds compelling even though the evidence has moved against it. That is where the turnaround investing destroys serious capital, not in the initial diagnosis, in the refusal to update the diagnosis when the evidence changes. So let me tell you exactly how I think about the mid thesis exit, because this is the discipline that separates investors who do it well in turnarounds over a long period of time from investors who have two big wins and then a catastrophic loss that that undoes everything. And the first thing I had to learn, and it took me real money to learn it, is the difference between thesis being tested and thesis being broken. Every genuine turnaround goes through a period where the thesis is tested, quarters where one metric disappoints, external condition that slows the recovery temporarily, market sentiments that turn negative on story even when the fundamentals are progressing. These are tests, and the correct response to a test is to hold, reassess the evidence, and confirm that the thesis is still intact before adding or reducing. The thesis being broken is different. It is not one disappointing quarter, it is a pattern. Multiple metrics moving in the wrong direction simultaneously. Management consistently failing to deliver on specific commitments. The scorecard turning from amber to red across more than one dimension over more than two consecutive quarters. The diagnoses I use to distinguish the two and three question are the three question I asked in order. Question number one: has the original cause of decline been addressed, or is there evidence of reinserting itself? Re- in the position I described, the cause was operational mismanagement under a previous leadership, under the same leadership. A new man, there was no new management. There was not really any disclosure or anything why this is going on. The image was really unclear and not transparent at all. That was evidence that the problem was reinserting itself. Even if it's not fully reinserting, it's like it's still gonna impact you if it does. When when the answer to the question moves from a yes to uncertain, that is the first signal to move to a high-end monitoring. Not exact, just high-end monitoring. High-end monitoring. Question two. Is the execution evidence moving towards the thesis or away from it? Apply the scorecard, not even not to one quarter, to the pattern across 3-4 quarters. Are the green metrics staying green? Are the amber metrics resolving towards green or deteriorating towards red? Is the overall direction of the scorecard improving or worsening? In the position I held, the direction was consistently worsening, not dramatically in any single quarter, but the trend across multiple quarters was ambiguous. When I forced myself to look at it without the bias of wanting it to be right. Question 3. If I did not already own the stock, would I buy it at this price with this evidence? This is the most important question, and it is the hardest one to answer honestly, because ownership creates psychological attachment that distorts judgment in ways that are almost impossible to fully eliminate. The way I force honesty in answering it is I imagine explaining the current evidence to someone who has never heard of this company, not the original thesis, the current evidence. The metric that as stand today, the guidance misses, cash flow divergences, the cost target not reached. If the if that person hearing the current version without the history of conviction would not buy the stock at the current price, then I should not be holding it either. Because holding and buying are economically identical decisions. The fact that I already own it is psychologically significant but financially irrelevant. In the position I described, when I forced myself through that exercise honestly, the answer was clear. The current evidence presented without the history of conviction did not support the position at the current price. So I exited. Now I want to address the emotion of this directly, because the myth thesis exit is not just analytical. It's not just an analytical decision. It's a psychological one. Like, I'll go through another example for this. So I invested in this company around here. So I invested in this company around here in August 2024, and I felt like I felt like it's down too much. And it's gonna go up. But then after a few months, the results weren't improving. Nothing else was looking good for the company. So I thought of this as a mid thesis breakdown. And then suddenly this happened. And then suddenly the Adani bribery case happened in the US. So I was like, this is a great buying opportunity, and I should really get some cash to buy it. So at that time in November 2025, um in November 2024, I was around that. Adani and Seoul. Let me just check. When was that? Because I'm forgetting. Yeah, it was around here. Yeah. So I sold this at a loss, at a little bit of a loss, and then I bought Adani because I thought that stock, nothing had changed. There was only allegation of bribery, and I was practically buying the stock at a really big discount. So let me just see. So I buy it at here. I sell coffee there. I buy it here, and then after a few months, my stock is 95% up. So this is what I'm saying. You have to weigh two stocks together and see which one gives you more money, which one is better. And if you think your mid thesis exit is justified because your stock is not performing, your stock is not performing, not not the stock performance, the fundamental performance. That's the main thing. S- Okay, your stock is not performing, and you have a better thesis there, which is really cheap to buy right now. So you can exit this and buy that, and it pays off most of the time. Sometimes you exit this and then the stock goes um up like crazy. I'm forgetting the name of the stock. Let me just. So I exited this stock right here. I exited the stock right here to buy some other stock, and then this stock moved 60-70% up. So this will happen sometimes. It's You can't really predict this, but yeah, but most of the time, whenever you do that, it should be a good decision. I've talked. Okay, so now I want to give you the complete framework, the actual checklist I run before I put capital into a turnaround candidate. That filter, if applied rigorously, catches most value traps before they become positions rather than after. So let's build it together. Every position in my portfolio started here. Not the valuation, not a valuation model, not a quarterly result, not not with a news headline or a stock screen. or a tip from another investor. It started with this document: 7 questions applied in order. Before I before I open a spreadsheet, before I open an annual report, before I spend a single hour of research time on a new name, because of because research time is capital. It is finite, and the single most important allocation decision I make is not with stocks to buy. It is with stocks that deserve the research that precedes the buy decision. This checklist is a filter that makes all allocation decisions. If a stock fails any of the three questions, I stop immediately. No further analysis, no exceptions. The first three questions are binary gatekeepers. They exist to protect research time from being spent on situations that cannot produce an outcome the thesis requires. Question 4 through 7 are not binary. Questions 4 through 7 are not binary. They are graduated. They tell me how much conviction the position deserves, how large the sizing should be, and how closely I need to monitor the thesis as it develops. Let me walk you through each one. Question number 1: why did the business fall, and is the cost fixable or permanent? We've spent significant time on this already, so I'll be precise rather than exhaustive. The answer must be fixable, clearly specific, demonstrative, demonstratively fixable for the analyst to proceed. Not not probably fixable, not possibly fixable, with the right conditions. Fixable with a credible mechanism that can identify and monitor. If the cause is permanent structural demand destruction, permanent competitive displacement, debt beyond recovery capacity, stop here. The stock is cheap for a reason that will not change. No further analysis required. If the cause is ambiguous, I apply a perfect execution question. If perfect execution all over 3 years produces a genuinely viable competitive franchisee, I may proceed. If perfect execution merely slows the structural decline, I stop. Sometimes I don't even proceed if the perfect execution produces a competitive franchisee, because the main the highlighted word here is perfect, and having a perfect execution is has really low chances. So I would rather invest in a fixed I would rather invest in a low risk and a medium reward investment that has a fixable cause than an ambiguous one. This question alone eliminates the majority of beaten down stocks from further consideration. That elimination is the point. Okay, question 2: does the core business still have relevant demand? This is distinct from question 1, and the distinction matters. Question 1 asked about the cause of decline. Question 2 asks about the destination of the recovery. A business can have a fixable cause, governance failure, temporary over leveraging, and still be recovering into a market where demand for its product or service is structurally weakening. The management problem gets solved, the demand problem doesn't. I want to know if the business executes its recovery perfectly. Is it recovering into a growing market, a stable market, or a shrinking one? because the same recovery delivered into different demand environments produces dramatically different investment outcomes. Growing or stable market demand is a sign you should proceed. Structurally shrinking demand is a sign that you should stop regardless of how fixable the causes appear. Question number 3. Has the management responsible for the failure been genuinely replaced? Genuinely is the operative word, and I want to be precise about what genuine replacement means, because this is where the most expensive mistakes in turnaround investing are made. Genuine replacement is not a new CEO within the same board. It is not a leadership reshuffle that leaves the cultural architects of the original failure in a place below the title level. It is not cosmetic governance changes to satisfy regulatory requirements without changing actual decision making. General replacement means the people that proceed and the incentive structures that created the failure has been structurally removed and replaced with something demonstratively different. New leadership with a mandate to change, board composition that provides real oversight rather than rubber stamping, institutional shareholders with the capability of, and the motivation to hold management accountable. The diagnostic I use is, would the previous management, if reinstated tomorrow, be able to recreate the same failure within the existing governance structure? If yes, the replacement is cosmetic. If no, it is genuine. Cosmetic replacement, that means you should stop. Genuine replacement is good. If a stock has passed all of these three questions, the cause is fixable, the demand is relevant, and the management has genuinely changed. It has earned the right to serious analytical attention. Now, the remaining four questions determine the quality and the sizing of the position. Question 4. Does the balance sheet have sufficient runway? Turnarounds take time, almost always longer than the initial thesis suggests. A business with fixable problems and genuine management replacements still needs to survive long enough for recovery to be materialized. The balance sheet survivability determines whether time is available. I look at three numbers: cash and liquid assets available, debt service obligations over the next 24 months, and operating cash flow at current depressed levels. Can the business service its obligations and maintain minimum operating investment for at least 2 years without external capital infusion? If yes, the balance sheet has run away. The thesis has time to develop. If no, even a genuine turnaround can fail because the clock runs out before the recovery arrives. This is not a stop signal, it is a sizing signal. A business with very limited runaway but a genuine thesis gets a smaller initial positions in with sizing contingent on capital raise execution. Question 5. Is there any early execution evidence, however small, that the recovery is real? This is the question that separates turnaround investing from speculative recovery hitting. I do not require full confirmation before entering the position. By the time full confirmation exists, the market has already priced it, but I require something more, one verifiable, specific piece of evidence that the recovery is not just announced but already beginning to manifest in observable data. In banking, deposit growth recovery is early execution evidence, and it is behavioral, verifiable, and directly linked to the core thesis of trust rebuilding in retail. Same store sales establishing before turning positive in manufacturing. Order book in manufacturing, order book recovery precedes revenue improvement. In business operating cash flow, in any business operating cash flow turns positive before reported earnings recover. Small evidence is sufficient. I'm not looking for confirmation. I'm looking for a signal. The difference between a business with no early execution evidence and one with small but genuine early execution evidence. And this is the difference between a speculative bet and a profitability weighed investment. No early evidence, smaller initial position, shorter monitoring leash. Early evidence present means standard position sizing and longer conviction runway. Question number 6. Is market optimism ahead of execution evidence or behind it? This is my signature filter. The one I developed from the most expensive mistakes in my own portfolio. I want to own turnarounds where the market is skeptical despite evidences of genuine recovery, not the turnarounds where the market is optimistic despite limited execution evidence. The distinction sounds obvious. In practice, it is remarkably difficult to maintain because market optimism creates social proof that feels like validation. Other investors buying the story, analyst upgrades, positive coverage, growing retail interest, all of these create a narrative environment that feels like confirmation of the thesis. It is not confirmation, it is noise, and a dangerous noise because it raises prices precisely when the execution evidence may not yet justify it. And plus, think of it like this: 99% of the retail investors lose money. So, if all of the retail investors come into the stock, start buying it like crazy, then what do you think the stock will do? This stock will, of course, lose money because retail investors are buying it, not the FIIs, not the DIIs, the retail investors. So, in a general rule of thumb is that you should always do the opposite of retail investors. Okay, the diagnostic I use for this is to compare the current price movement to the current execution evidence on a scorecard. If the stock has already moved significantly on the story before the metric confirmation, the story, before the metrics confirm the story, market optimism is ahead of execution. The position is pricing in recovery that hasn't happened yet. In the situation, in that situation, I wait or I enter a smaller initial position and size up only as execution evidence accumulates and justifies the price. Or I don't even enter it because the price is too high. Market spect, skepticism, despite genuine evidence, for means you should enter in it, and market optimism ahead of execution evidence means you should reduce initial position sizing or you should not enter or you should wait. Question 7. What specific metric or event would break this thesis, and am I prepared to exit when it arrives? This is a gen this is the question most investors skip entirely, and this determines whether the turnaround position is managed with discipline or held with hope. Before I enter into turnaround positions, I define the thesis break condition explicitly, not vaguely, specifically. A name, a named metric crossing a named threshold over a named period of time. For a banking turnaround, gross NPA deterioration above a specific level after two consecutive quarters of improvement would break the asset quality thesis. ROE failing to improve above a specific floor of oversight over eight quarters would break the return normalization thesis. Deposits reversing for two consecutive quarters would break the trust recovery thesis. I write these conditions down before I enter the position, and when my judgment is the clearest and my bias towards the thesis the weakest, because once I own a position, every piece of the evidence gets filtered through a psychology of ownership, pre-committed to exit conditions when I'm still objective is is only reliable and is the only reliable antidote to that bias. When the predefined condition arrived arrives, I exit without renegotiating the condition, without giving it one more quarter. The condition was defined when my judgment was the clearest. I trust that judgment over the judgment I make while sitting in a loss. And one more thing I would like to mention is you have to have a exit price or a exit criteria. If you're just investing in turnarounds because you want to buy and hold, that may not be a very good idea because turnarounds are volatile. And buy and hold works really well when there's a growth stock or a stock with a great business in a relatively low penetrated market or sector. So I recommend people have a exit criteria or a exit target price um, created by technicals or fundamentals before they invest in the stock. Okay, 7 questions applied in order before a single hour of deep research. The first three great the first three are gatekeepers. The next four are calibrators. Together, they do one thing: they ensure that every hour of research I spend and every rupee of capital I deploy into the turnaround candidate is going into a situation where the fundamental conditions for a genuine recovery are present. They do not guarantee the recovery happens, nothing does. Turnaround investing is probabilistic. Sound process applied consistently process produces good outcomes over a long period without producing perfect outcomes. In every individual position, what this checklist guarantees is that I'm never surprised by an value trap that I should have identified before I entered. The failure that remain, the position that pass the checklist and still don't deliver, are the ones where execution disappoints despite genuine condition for recovery. Those positions are where mid-thesis monitoring and exit discipline do the work. But again, every every turnaround can fail. Okay, like you will encounter turnarounds that go bankrupt, and you will certainly encounter investments that you made a that had a total capital loss. You can't prevent that. From, I want to end with the most honest thing I can tell you about turnaround investing. You will get some wrong, not because the framework failed, not because the research was insufficient, not because you weren't paying attention, but because turnaround investing is fundamentally a probabilistic exercise. And in a probabilistic exercise, sound process and bad outcomes coexist. They always have, they always will. The goal is never hit a perfect hit rate. The goal is something more specific and more achievable than that. Asymmetric outcomes managed by disciplined framework. What that means in practice is when the framework is right, the execution delivers. The upside is genuine, turnaround is sufficient. A business is recovering from distressed multiples to normalized multiples, with the earnings growing simultaneously, produces the kind of return that meaningfully moves a portfolio. Asymmetry works in your favor. When when the framework is right but the execution disappoints, the mid thesis monitoring catches it, the scorecard turns amber, then red, the thesis breaks, conditions arrive, you exit, the loss is real but contained. Because the framework told you when you leave before the position became catastrophic. When the framework is wrong, you misdiagnose a permanent impairment as a fixable cause, the most expensive outcome, and it is the outcome this entire framework is designed to minimize, not eliminate, minimize. Because elimination is not possible. Anyone who tells you they have a framework that never produces wrong diagnosis either is not taking enough risk or not being honest about their track record. Even the 7 questions I've shown today, applied in order, answered honestly, without the bias of wanting a stock to be a turnaround, will not catch every value trap. It costs your before it costs your capital, but they will catch most of them. And in the category of investing where the downside of a missed value trap is severe and the upside of a correctly identified turnaround is significant, catching most of them is enough, more than enough. It is the foundation of a process that compounds meaningfully over time. Now I want to tell you something about this channel that I think is important for you to understand as a viewer. Every stock analysis I publish here has been through this filter first. The names that make it onto the channel, like Yes Bank and Team Lease, the positions I discuss publicly are names that all pass the 7 question, not perfectly, not without amber flags, but they passed. The names that didn't pass, I won't always tell you about those. Sometimes I will because the misses are instructive as the hits, and I've already told you that I've exited the position with thesis when the evidence moved against me. The transparency is intentional. A channel that only shows the wins is not showing you the process, it shows you an highlight reel. This channel is not a highlight reel, it is a real time record of how I think about capital, the framework, the application, the monitoring, and the occasional exits. The complete picture, because the complete picture is the only one worth building a track record on. And here is the two sentence thesis that sits underneath everything I've shown you today. Turnaround investing is not about finding cheap stocks. It is about finding businesses where the market has is priced a permanent impairment, and that is actually temporary, and having the framework uh, to know the difference, the discipline to monitor it honestly, and to courage to exit, and the courage to exit when the evidence says you're wrong. That is the standard I hold every position in my portfolio to. It is the standard I will hold every analysis on this channel to. If this if this is the kind of investing you want to understand more deeply, subscribe, because there is significantly more outcomes. And if you haven't watched the Yes Bank video, the Yes Bank deep dive that this framework was built around, that video is in the description. Watch it with these 7 questions in mind, and it will look the different, and it will look different the second time. I'll see you there. Thank you.